You're listening to an episode recorded during the time Innovation Fuel was part of University Canada West. We are proud and grateful for the work we've done together, and we want to thank the university for being in our podcast. We are now excited to continue the journey of Innovation Fuel into its next chapter. Thanks for listening.
You're listening to Innovation Fuel, a business podcast by University Canada West.
Bringing you fantastic stories from accomplished entrepreneurs and key industry professionals. Let's explore the entrepreneurial world through local businesses and our university community. Hello, Gelareh.
Hey, Dave, how are you today?
Good. Always when I say your name, it's almost like I'm singing.
That's awesome. My friends and colleagues actually say my name correctly. That was great. Thank you. It's a long time to say my name correctly. I'm not changing my name, just let you know. Okay, Dave, do you remember, when we started the Innovation Fuel, we had a lot of episodes with investors, with entrepreneurs, with venture capitals, and most of them, they really want you to do the bootstrapping, not raising money, don't go for fundraising or investors.
Well, they talked about owner's equity, and they talked about this element of how do I hold on to as much of that owner's equity as possible and grow my business and really grow it so that I have that element to grow it before I go out and look for additional funding. Can I find other sources of funding before I go out and look for additional funding out that's going to give up some of that owner's equity? But I think we might have someone here that might have a different opinion.
Exactly. We have entrepreneur. It means we had a Paul McKenzie before from NexOptic. So he actually raised money and also he went public. So we want to see in the startup mode, he went public. So we want to see his idea and what was his experience about going public and raising money. Let's welcome back Paul McKenzie, the CEO and founder of NexOptic.
Yes, welcome to Innovation Fuel, brought to you by University Canada West. Yes, we are excited. Paul left us with some really deep thoughts. I hope you've been changing. I hope you individually out there, if you haven't listened to the episode, go listen to it. Pivoting yourself. And we're talking about artificial intelligence, machine learning, and the success that Paul and his organization NexOptic have had outstanding success. But we also left that episode talking about funding and talking about, as you go into the startup mode, you're in these organizations, these tech startups, how are you going to getting the funding? I hear through a little bit of a story that I think Paul is pretty successful in doing this. Is that right, Paul? Are you successful in funding, my friend?
Well, Dave, I am in for the right opportunity, the right time, and the right climate. And I have managed to raise a fair bit of money for getting companies started.
We want to hear your story about how you could raise $120 million for your company. And so what was your challenges and your successes?
I mean, we're fortunate in Canada. We have a very entrepreneurial society here. We're a country of immigrants and people, took big risks to come here and really needed to reinvent themselves. They wanted to start a fresh start. Our stock exchanges were built on startup companies initially, with the industries of the day. So, mining and logging and then oil and gas and ultimately shifting into tech and so forth. So we're fortunate to have in Canada one major global exchange, which is the Toronto Stock Exchange, but we also have some smaller exchanges. And we're actually, in my opinion, we're the best location in the world for startup capital, in the sort of $2, $5, maybe $6, $7 million range for a startup. And there's a lot of other countries' exchanges are just not built for those small amounts, and nor are there financial institutions. They just won't look at them. They'll say, look, we're not interested. It's not worth our while. We're not even going to bring a lawyer in or anyone in a valuation of any kind unless you're looking for 100 plus million or even higher numbers. We've got this niche market with these highly regulated, very there's a high bar, high threshold. And there's a lot of global companies come here to get listed on this exchange for that very reason. And, that's where I started. I've been lucky enough to, do raises from anywhere from 2 million. I think the biggest raise I've done at one given time was about 14 million bucks. And you can go back to the well. You don't have to turn a profit. You don't have to be at revenue to go back. You just got to show a continuation of your narrative, a continuation of your story. You can show some success. And again, the Canadian investor, just historically, we've been willing to take some risk. We've been willing to put up some capital for a good idea. Now, our exchange, I'll add, has some shady history to it. There were some bad actors, and some of them quite famous. A few very famous cases that made global news. But the regulations have really gotten better. There's very, very little of that. It's very hard to get away with that, and the penalties are very severe. So the bad actors tend to have kind of fallen off the tree and gotten out of the game.
So, Paul, when you started out in this world of going and chasing down funding, tell us about the beginning of the story. Because was it always that easy at the beginning, or what did you learn from your early days of going into the funding world?
Well, I started in, I remember this is back pre big internet days, but we were getting stock quotes out of the newspaper, and I started to play the stock market, back in my 20s. And I remember on the junior stock exchange counting every stock quote in the paper for the junior exchange, and it was about 2,000 companies. And I realized that there's 2,000 companies out there in Canada that are looking for ideas. They're looking for product. They're looking for something to get their teeth into. And so that's where I started. I started being a broker of ideas and companies. And salespeople are good at if they're natural, if they have a passion for something. And that's where I categorize myself in. I can't fake it. I can't pretend to sell anything I'm not, remotely interested in. But and I'm not a good cold caller, but I started to phone up some of these companies with some ideas, and nobody yelled at me. No one hung up the phone at me. The worst I ever got was, "Thank you so much for thinking of us. Man, that's wonderful. If you have some other ideas in the future, give us a call." And that was kind of the unfriendliest calls I ever got. So I was brokering projects with companies that they could go and get funded on. And then I worked, I had worked on the floor of the stock exchange for some time, and I built up a network. So when I ended up starting my own company, I had a little bit of a network, and I called up some of the brokers and that I knew, and they started putting capital in. And my adage is, in business is when there's money, there's a company. And if without it, you can't move. So in Canada, we're in a great spot for good opportunities to get funded. But then, then you're a public company, and that comes with a lot of extra costs, a lot of extra accountability to shareholders. And it's something that in other jurisdictions in the world, people wait longer before they go public. So pros and cons to going public at an early stage.
And I just want to tail off that really quickly. I know Gelareh's got lots to ask on her side of things, but tail off that element, making that decision to get your funding from a public source versus keeping it private and trying to bootstrap it.
For me, it was easier to get, I can't remember what my first raise was when I started my first company, a public company. I think maybe we did $3 or $4 million or something like that. It was just easier to get. And the investors they had immediate liquidity as a public company, and they could even make money before the company, you knew which direction the company was going to go. So the company doesn't have to suddenly have a big earnings, but there's, if you do a round at, 10 or 15 cents a share and the share price goes up to 45 cents a share, your shareholders have got liquidity and they have an opportunity to make some money. So that's why. So for me, it was the most accessible capital. And it wasn't too complicated. And it was a network I was involved in at the time that just made it easier for me. That's how it worked. I've been approached to raise money for other things, charities, private stuff, and I have not had the same success as the public markets.
Let's talk about the stock market, because you raised money before January 2023, correct? But during the January 2023, there was the stock market for AI really went down. And so how that impact you and how you can gain the trust for the investors?
Yeah, that's a great question. It's the stock markets are finicky and cyclical, and money wants company, and money follows money. People follow people. Money follows money. And if you're in a sector that's quote unquote hot, where, if the gold price goes up $200 an ounce, suddenly, it's not as difficult to raise money in the gold sector. If gold's down $200 an ounce, it gets trickier. So it's kind of, sometimes it's a little bit of the flavor of the day, and also sometimes, you get in these bear markets and sometimes an extended bear market. So you capture the money that you can, and you want to spend it wisely, effectively, efficiently, and you want to continue strengthen your narrative, strengthen your storyline. So like if somebody says, look, I'm going to give you $1,000, by the time you've spent that $1,000, where will you be? You say, look, this is what we're planning to do. So you create a term sheet, you show what your dilution is going to be, you show what the share price is going to be that they're buying in. You put a warrant attached to it, or a half warrant, which is like a sweetener. It's an extra bonus for them to pick up more shares. And you give them a timeline. Say, look, we're going to go from we plan with this capital. You're going to give us a check for $1,000. We're going to issue you some shares and a warrant or a half warrant, and we're going to go from A to B. As the saying goes, bleep happens. So you're planning to go from A to B, and sometimes you don't want to start throwing good money after bad. So you might have to do a pivot, or you might have to do a redirect, or things might change. With the money you capture, you want to spend it effectively. And sometimes it's advantageous to not collect all the money you want, because it forces you to work smarter. And I call it, kind of getting drunk on a big raise, and everyone's giving themselves a raise or doing whatever. It's not the best management of the shareholder money. Even when you finish a raise, you still want to go with that mentality of bootstrapping it, and you want to focus on where that money's going to get you most effectively.
Because now the stock market of AI is getting better, but it's not as good as before, but it's really getting better. So what is going to be your next challenge? Do you need still more money to raise, or do you are in the right place of that one? So
in our case, NexOptic personally is we really need to deliver solid results for our shareholders. We need to demonstrate that our product has mass global appeal and could be integrated in a significant way into a multitude of large corporations. We need to demonstrate that. We've had a lot of good signs and indications on the way, and that's kept investors coming, writing checks. Older investors have been with us a while, or new investors coming in. But, at some point, your storyline gets, flat. As remarkable as the tech is, they would say, look, that's great, wonderful. You build some great tech. You've got to execute. Let's see that execution. So for us, the challenge is to close that significant customer that will turn some heads in the financial markets, for other corporations to come and knock on our doors.
Several entrepreneurs, they believe that they should not have they should not go for money fundraising, and they should earn their money by themselves. And some of them, like you, they're very successful in the fundraising. Can you tell me why you approach this way?
Yeah, we get into big dollars. I have thrown, it's all money's relative. $50 is a stretch for one person, and $50 million is a stretch for someone else, so it's relative. But for me, I have put in, I've invested hundreds of thousands of dollars of my own money in my company and companies. And it really comes down to, if you're doing the bigger raise, you just don't have the pockets for it. And I guess the argument is, when do you want to go public? Like, at what point? And many would argue that, the Canadian exchange, particularly the venture exchange, and the CSE exchange, the junior exchanges, companies maybe go public too soon, but it works for us. So others would say, look, we're not going to, why do you go public is also another question. And why you go public is one of the main reasons, not the only reason, but one of the main reasons is to raise capital. And so you get to a point where you're raising capital beyond the risk money that the founders are willing to put up.
Would you say, Paul, it depends on the industry? Like, we say tech, and and we're talking about artificial intelligence here. You kind of think you need to blitzscale a bit here, because if you don't blitzscale, someone's going to come take your lunch. And so the advantage to moving towards that public market would give you the opportunity to raise quickly to give you more validity to the next day.
Yeah, exactly. So, in our case, we put the money to work right away, and it got us along the road a lot quicker. So if we were bootstrapping it privately, which might have been harder it would have been harder for me with my background and my network to raise capital on, we wouldn't have gotten as far this quickly. So, this AI and the pivot, towards artificial intelligence and software. We only started this pivot about 3 years ago. And so, we wouldn't have gotten here with private equity, I don't think.
So there is another kind of code about the BC market or Canadian market for a startup is that it's really hard for a startup to grow. And that's why a lot of startups go to US. But for you, it means that's why you are staying here. You're thinking the Canada is actually a very good environment for startups, especially BC.
I think, you don't need to give up on an early stage company. You don't necessarily have to give up as much to outside investors. And if you're looking for seed capital in a private organization in the US, venture capital, you may end up giving away a lot more of your personal ownership. So the founder's ownership may get diluted a lot quicker. And then you're the first money you raise is probably not going to get you where you need to be. And then you're going to have to go back to the well again and back to the well again. So they can end up squeezing you out more effectively, potentially. And I think you've got less dilution of owners and better structure for the shareholders in general going public at the right time. Keep in mind too that if you're doing big raises, then the US is probably a better place for you.
But I have a question because you keep saying that it's the right time going to public. For a tech startup in BC, what do you think is the right when is the right time for them to go to public?
That's a very good question. I think when the management has the stomach for it, I guess. Because it comes with a lot of challenges. I mean, you're always beholden to your shareholders. You're always working for your shareholders, whether there's one shareholder or you got several thousand. So you suddenly got a lot more shareholders. A lot more owners out there. And, the pressure is on to deliver. Also, there's this immediate measurement of how you're doing in the share price. Often share prices get ahead of themselves. They have a high, a significantly higher valuation that they may deserve, that may be realistic. And at other times, the share value is very low. The market cap of the company is very low, and it's not really reflective of the strength of what's going on behind the scenes. And you've got to deal with that. And at any given time, with that, moving yardstick being the share price, you've got somebody upset. You've got guys that bought in at higher prices and it's come back down. And so you have to deal with that. You also have a lot more costs, a lot more legal costs. There's listing costs. There's insurance costs. There's all types of things you've got to deal with. And reporting too, accounting, auditing, and quarterly financial reports and so forth. So there's a lot of moving parts. And so when do you want to go public? Yeah, it's when you're... If it's a viable place for you to get capital, you got the stomach riding that roller coaster of being a public company.
Because you've been CFO, you've been founder, you've been CEO. Do you think that all of these different experience and diverse background could help you with this position that you have right now?
Oh, yeah, 100%. I mean, I'm learning every day. And I mean, just with this company alone, I mean, I'm much better at handling situations and things. I'm much calmer about situations than I would have been even just a few years ago. So it's a good education going public for sure.
This has been a really interesting conversation in multiple different ways. But one of the questions that's kind of sitting in the back of my head, and I go back to 2000 to the .com bust. Do we see something like this happening in the future with this AI element? Are we running too fast at AI, or are we got all our checks and bounds in place? So we don't run into that element, because before the .com element, we were investing in nothing. There was just something. So I don't know. What's your thoughts on that?
That's a great question. I think in many ways, AI is still in its infancy. And I guess the complexity of it is how rampant is it going to become? How significant? And how are these solutions going to reinvent themselves? So, at one given time, you think you've got the best system, the best product, best solution. You very likely may, but 6 months later, some 20-year-olds out of MIT might just put you out of business, But from the perspective of like boom and bust, a real estate boom, or if there's a particular metal boom, let's say gold market, and then the gold price comes back, or I think there's still a lot of growth in the AI space. I think the thing that makes it unique is how rapidly it's changing and how rapidly it's evolving. And even from our perspective, I mean, solution just gets continuously better, even with the small team that we have. So that's the, maybe not so much as the boom and the bust, but as to, how this industry is fast evolving, and it's a baby. AI is an infant, as to, one day it'll be an old man or an old woman, but right now it's a baby. baby.
I absolutely love it, my friend. I love the conversation as usual. This has been great. But before we wrap up today's episode, I got to ask you again for another challenge, maybe a different challenge here. Thinking about the, again, macro, micro album, whatever you think might be something we should walk away from and think about from this conversation.
Okay, sure. I would go me on the spot again, Dave, but I will say I guess the challenge would be a macro one, and as to what are you working towards specifically, as an individual, and where will that be in 6 months, 2 years, 5 years? And I really, having said that, kind of looking out what could change or what might evolve, you can't get too hung up on that. So really, where do you want to focus specifically in this fast changing world? And knowing that maybe in 6 months from now, the thing you were after maybe have changed so much that you need to change direction as well. So what are you excited about focusing on right now? Like right now?
Thank you very much. Thank you. It was a great episode, Paul. Thank you, Dave. Thank you, Paul. That was another episode of Innovation Fuel.
Thank you all.
Thank you for listening to Innovation Fuel. We are on all podcast streaming platforms, Google, Spotify, and Apple Podcasts.
Visit our website at www.ucanwest.ca/innovation fuel. Also, follow us on Instagram at innovation_fuel.